Today, we are talking about how to get funding for your business. So there are a lot of different types of businesses out there. There are service-based businesses, there are product-based businesses, you could be a consultant, you could do some kind of freelancing, you could do what I do, which is more of like a blogger, or a podcaster, YouTuber. I'm more of an educational kind of person. So there are a lot of different types of business models out there, and not every funding source is necessarily a great one for your business. So with this video, I want to get really comprehensive. This is going to be a long video going very in-depth, a lot of logic I'm going to apply here. I nerd out about this stuff. I love talking about business, entrepreneurship, finance, all that kind of stuff. So I'm going to sort of lay everything out in front of you, everything under the sun in terms of how you can get funding, and then I'm going to leave it up to you to choose the one that is best for you, though I will make a recommendation. The first thing that I want to share with you is sort of like a more of a personal story. When I was a sophomore in college, going back to my college days, I had no idea what I was doing with business. So what I decided was okay, I don't know what I'm doing. I don't want to launch my own business because I know it's probably going to fail. What if I go and learn from someone else? So I ended up interning at this restaurant loyalty app company. It was a startup. It was literally two guys. And one of the guys was more of the technical co-founders. The other guy was more of the manager and the salesman and that kind of stuff. And I was I went and worked for them, and it was free. That's the only free internship I ever had in college. But I learned so much. I learned more than my paid internships by far. It was almost like an accelerator program, if you will. It was the first time I ever spoke in public. That was the first time I ever tried to do sales. I literally went into a restaurant and tried to convince the owner of the value of our app and why he should become a part of the community. And I was so nervous, I was so timid and really quiet and just stuttering and stammering over myself. But it made me get through that hurdle. It made me a much more confident speaker. And I urge anyone, if you're a younger person in the audience, to seek out these kinds of opportunities. But long story short, the guy who founded this company ended up doing it based off of an angel investment round. So this was an angel investment round of $50,000. So he raised $50,000 of angel investors' money. First of all, an angel investor is basically a high net worth individual. It's someone who has, they've earned over $200,000 per year of income, or there's reasonable expectations they're going to do that in the future. They might also have, over $1 million net worth, excluding their house. There are some various things that go into this definition, but the big takeaway is that they are a high net worth individual. They can afford to have a financial loss, and they're willing to invest in your company. So he ended up finding his angel investor based off of his own network. This was another entrepreneur that actually found out about what he was doing. He shared what he was doing and the reason why he was so passionate about it. The angel investor bought into that vision and ended up supporting him. So you can do the same thing. If you want funding for your company, I would say the first outside of friends and family kind of round is usually angel investment. It's finding someone who's willing to actually put money into your business, usually at the seed stage, maybe at the idea stage, but they're willing to buy into your vision. You can do that by networking. You can do that by finding people who are interested in entrepreneurship. They're already successful business owners, that kind of stuff. That is one way that you can get funding for your company. There's also friends and family. Friends and family is usually the initial round when it comes to a company. You're usually asking your friends and family to support this business project based on your own work ethic, based on the successes you've had in the past, based on their relationship with you. But make sure that if you are going to seek out friends and family as an investment source, that you're not doing it lightly. You're treating them like investors. You don't want to treat them as very casually, just family members. You want to treat them like an investor. You want to show them your path, the plan that you've put together to actually make this company work. You're going to treat them with a certain degree of professionalism. That's really the best way, the best service that you can do if you do start out with friends and family as investing in your company. The next biggest one on the table is VC investment. So VC investment being venture capitalists. So venture capitalists are very different than angel investors. Angel investors are usually individuals. They might invest at, say, $50,000 up to maybe $500,000 a super angel, a super angel investor is probably going to invest more at like the $1 million level, but it's usually people that are writing smaller checks into the business, and this is usually in the initial funding rounds. They are individuals. That's something really important to remember. A venture capitalist is different because it's actually a business for them. A venture capitalist is not investing his or her own money. They might do for like a small degree, they might be required to put their own money into the fund, but usually what they're doing is they're actually managing the financial assets of other people, and they're investing other people's money into these various startup opportunities. And basically the business model for a venture capitalist is, well, we maybe know a lot about finance, we know some about entrepreneurship, we have a hunch about these different companies, they have some good traction, they have a good track record, etc. It looks like they're going to do well in the future. We're going to invest in, say, 9 or 10 companies, and we're going to hope that like 1, maybe 2 of them are winners. So they'll invest in a lot of different companies. And usually, I'd say 1 or 2 of those companies fail. A bunch of them just kind of go nowhere. And then like there are 1 or 2 winners in that portfolio that end up making the bulk of the actual financial return for the investors. And that's usually over like an 8-year span. It could even be like a 10-year span. So this is a long-term investment. Later stage investors might come in when there's like a 2-year exit opportunity. These venture capitalists, unlike an angel investor, are far more geared towards looking for an exit opportunity. An exit is like if you decide to build this company, how are they going to get their financial return back? If I give you $1 million or $2 million that goes into the infrastructure of your company, how am I going to make money back? You could say retained earnings, doing a distribution, something like that. It's going to take a really long time to earn that back. Usually, what a venture capitalist will, when they earn that ROI, is when an exit opportunity takes place. So that's a liquidation event. So a liquidation event is when you sell a company, or it's when you go IPO. You do an initial public offering, you go on the stock market, and you offer your shares to the public, and then they can cash out their initial investment. So the actual liquidation event could be a sale of the company or an initial public offering. These are 2 ways that venture capitalists will actually gain back their money. The other ways that I want to talk about with the rest of this video usually are for smaller companies, small businesses. This is not a tech startup, if you will, usually. But the last one I'm going to talk about can be applied to tech startups and can be applied to, particularly if you're looking to build a really big company. So the first one of this next segment here is if you're looking to build a small business, a lot of people will actually go out there and they'll get a small business loan. So a small business loan being, you're getting a loan, it could be from the government, it could be from a bank, and you're using that money to do something. You're using that money to maybe buy a factory or to buy office space or to buy tools that you're using for your business, and then you are expected to repay that loan, to repay that amount to the bank. So the next way to actually get funding for your business is with a small business loan. You can do that for your business. You can do that for your restaurant, for a food truck. These are different types of things. You're gonna have to put together a proposal, etc., but you can get a loan for your business. Just keep in mind, you have to pay back that loan. Now, if you're not, credit worthy enough, or you're unable to get that loan for some reason, you can also use a service like Upstart. You can use a service like Lending Club. I'll include some links below in the description of this video to actually get a loan for your business. Aside from getting a loan, you can also just use retained earnings to grow your business. So retained earnings being, if you are the owner of a business, you pay yourself a salary, you pay your employees a salary, everything that's left over is profit. You can reinvest that into the business. And this is actually the way that most businesses grow. This is the way that most businesses grow from small businesses into large businesses. And the reason here is that this is kind of like a cash infusion if you think about it. The business is basically banking on the fact that because they rendered services previously, they're going to be able to do the same thing in the future, and more money is going to help them, is going to make them able to do that. So you can use retained earnings to grow your business over time. This is much more of a healthy organic growth. You're not diluting your control of the business. You're not bringing in outside investors, anything like that. You can use this as another way to grow your business. The last one, the last segment, this is really my area of expertise. Like, this is my specialty. I've written 4 books on this topic. I've written a book on real estate crowdfunding, on Kickstarter, on nonprofit crowdfunding, personal crowdfunding, a lot of different types of crowdfunding. This is my area of expertise. So the next way you can get funding for your business is with crowdfunding. Crowdfunding being launching a campaign on Kickstarter. You're getting funding from the actual customers who are end up going to be becoming long-term customers of your business. Like, these are the people that are curious about whatever it is you're doing, that they freaking love the product that you made. They want to support you. They want to see this business exist in the world. And they're willing to buy an initial production run of your product. So you can go on Kickstarter, you can go on Indiegogo, and you can actually raise money, raise funding for your business. But you can also do something called equity crowdfunding. So equity crowdfunding being, rather than giving away your product or doing a pre-order kind of a sale for your business with Kickstarter or Indiegogo, you can use an equity crowdfunding platform like Seed Invest, like WeFunder, Start Engine. There are a bunch of ones out there to give away shares of your company to the public, to offer shares to the public in exchange for investment in your company. This is sort of a newer thing. This is something that hasn't been going on until like the last year. It's been really gaining more traction. So if you want to get funding for your business, crowdfunding is definitely one of the things that should be on your radar. This is something you can actually use to get funding for your business. I've seen it start 6- and 7-figure businesses. It's also really responsible for a lot of the innovative technology that's come out in the last few years. Oculus Rift. You think of virtual reality, Oculus Rift, the technology that goes behind virtual reality, actually started on Kickstarter. It started on Kickstarter. The guy launched a campaign, raised a bunch of money, and then ended up selling his company to Facebook for like $1 billion, something crazy like that. So you can use crowdfunding to also do a cash injection into your business, get funding to do an initial order run, or get funding to start the business, invest in other things like that. You can use crowdfunding for this. So if you are interested in learning more about crowdfunding, I urge you, go and check out the link in this description. I put together a free introductory course which walks you through not only how to do one of these financial raises, how to get crowdfunding for your business, but also how to get, market this project and get attention in the larger media, how to get attention on the actual crowdfunding platform that you're going with. You're going to want to gain access to this course. It shares a lot of that. But also, if you want more videos like this, you can hit that subscribe button and you'll get notifications when new ones come out. I put them out pretty regularly. I'd say maybe one, sometimes twice a week on the topic of crowdfunding. This is a newer industry that more and more businesses are using to get funding, because rather than having to go to like a financial intermediary, rather than having to go to an investor like a VC or something like that, and really putting all that headache into actually putting together a portfolio, putting together something you can pitch them with, a presentation, and actually show them, like all that kind of stuff, and also having to like hobnob with these different venture capitalists, you can actually go to the source of people who are going to become your customers. You can go to people who already have this problem, who are looking for it to be solved by you, who are willing to buy into your vision. You can go to your actual customers to get funding for your business. And that's why it is so powerful. It's removing the intermediary and you're just going directly to the source. I think this is very common in many other industries too. We're seeing this in real estate crowdfunding. We're seeing this in more of like peer-to-peer fundraising. We're seeing this in, if you're doing peer-to-peer lending. A lot of the financial intermediaries nowadays are actually being pushed to the side, and we're going directly to the funding source. So if you want more information like that, be sure to hit this subscribe button. But again, my name is Salvador Brigman. I hope you got a lot of value out of this video, and I'll see you next time.